while being slightly fast-paced. The markets are currently closed for the weekend. As of the closing bell on Friday, October 3, 2025, at 4 p.m. Eastern Time, GameStop Corp, traded under the ticker GME, settled at a price of $25.38. This represented a significant downward move for the day, shedding 6.76% of its value. But to fixate on that single day's decline is to miss the far more intricate and high-stakes drama unfolding beneath the surface. The common expectation, the one that has defined this stock for years, is that GameStop is a vessel for retail sentiment, a pure play on market emotion detached from the old-world concerns of revenue and profit. The reality, however, is a company in the throes of a desperate and radical transformation, where every tick of the stock chart is a referendum on its very survival, and institutional players are placing complex bets that go far beyond the simplistic apes versus suits narrative. What is truly happening with the GameStop stock is a clash between a fading memory of a retail revolution and the harsh, unforgiving economics of a business fighting for relevance in a digital-first world. The prevailing belief, cemented in the market consciousness since the historic short squeeze of 2021, is that GameStop's valuation is a cultural artifact, not a financial one. It's a symbol of defiance, a community-driven phenomenon where investment decisions are made on social media platforms and powered by a collective desire to challenge Wall Street. Many who use platforms like the Robinhood app for Robinhood stock trading see GME as the ultimate icon of their movement. This narrative suggests that fundamentals are irrelevant, that cash burn doesn't matter, and that the only thing driving the price is the unwavering conviction of its retail shareholder base. The expectation is for volatility, for sudden, inexplicable rallies fueled by memes and social media chatter. This view is not entirely without merit. Sentiment does play an outsized role, and the stock remains a favorite for those engaged in self-investing looking for high-risk, high-reward plays. However, this expectation is now a dangerously incomplete picture. The reality is that the landscape has matured. While the retail army is a formidable force, the recent trading patterns reveal a more complex and nuanced battleground. Analysis of trading volumes leading up to the end of last week shows sophisticated options activity and block trades indicative of institutional maneuvering, not just small-lot retail buys. These are not the actions of speculators chasing a meme. These are calculated positions being taken through advanced platforms like interactive brokers, where traders dissect every piece of available data. There's a growing divergence between the public story and the professional's playbook. Let's dissect the recent market activity more closely. The drop to $25.38 was not an isolated event. It was the culmination of a week that tested key support levels. What's more, this price action coincided with a significant corporate development, the record date for a special dividend of warrants. As of October 3rd, shareholders of record are set to receive 1 warrant for every 10 shares owned, giving them the right to purchase a new share at an exercise price of $32. This is a strategic move by management designed to raise up to $1.9 billion in capital. The expectation is that this provides loyal shareholders a chance to increase their stake and fund the company's future. The reality is much more complex. The issuance of up to 59 million warrants creates a potential overhang of future share dilution. The market's reaction, sending the stock down, suggests a degree of skepticism about this capital-raising strategy. Professional investors using Fidelity investments or managing Fidelity IRAs would be analyzing this not as a gift, but as a necessary and perhaps risky move by a company that needs cash for its ambitious and as yet unproven turnaround plan. While it avoids immediate dilution, the 32 strike price now looms as a major psychological and technical barrier for the stock. Beneath the headline-grabbing price swings, the company itself is a paradox. GameStop is, at its core, a brick-and-mortar retailer of physical video games in an industry that has overwhelmingly shifted to digital downloads. Its primary business model is in secular decline. Store traffic is a constant challenge, and the pre-owned games market, once a cash cow, is shrinking. To combat this existential threat, the company, under the leadership of Ryan Cohen, has embarked on a radical pivot. The strategy involves aggressively cutting costs by closing hundreds of underperforming stores, streamlining international operations, and building a fortress-like balance sheet. The recent quarterly reports have shown surprising profitability, but this has been driven almost entirely by cost-cutting, not by top-line growth. The expectation is that a leaner company is a healthier company. The reality is that you cannot cut your way to long-term growth. The company is simultaneously attempting to become a major e-commerce player and a hub for digital assets and collectibles. It has expanded its product catalog to include high-margin items like Pokémon cards and other collectibles, leveraging its brand recognition with gamers. Furthermore, it has made forays into the crypto space, including a significant investment in Bitcoin and a now-shuttered NFT marketplace. This signals an ambition to transform from a simple retailer into a diversified technology and investment company, perhaps akin to a holding company that allocates its large cash reserves. This is the ultimate bull case, that the cash pile will be deployed astutely into new high-growth ventures. Many exploring online investing through platforms like Sophie Invest are drawn to this potential. This brings us to the future outlook, where the chasm between expectation and reality is at its widest. The optimistic scenario, the narrative that keeps the faithful engaged, is that GameStop will successfully leverage its brand and cash to become a dominant force in Web3 gaming and e-commerce. In this future, the company builds a seamless digital ecosystem, its collectibles business thrives, and its strategic investments generate massive returns, justifying a valuation far beyond its current retail operations. This is the expectation that fuels the dream of another monumental surge. It's the belief that management's quiet, often cryptic strategy is a sign of genius at work. Comment below what you believe is the single most critical step GameStop's management must take to make this digital transformation a success. The harsher reality is that this path is fraught with immense risk. The company faces staggering competition in the e-commerce space from giants like Amazon. The NFT and crypto markets have proven to be incredibly volatile and are still seeking mainstream adoption. The core video game industry is dominated by digital storefronts like those from Sony, Microsoft, and Steam, which have direct relationships with consumers. GameStop is, in essence, trying to build a new business from the ground up while its legacy business slowly erodes. Analyst price targets remain stubbornly low, with many forecasting a decline to the mid-teens, reflecting deep skepticism about the viability of this transformation. Furthermore, the broader macroeconomic environment, with potential constraints on discretionary consumer spending, poses a direct threat to both its legacy and emerging business lines. The success of automated strategies like Schwab Intelligent Portfolios is often built on avoiding the kind of single-stock risk that GME represents, highlighting the divergence between traditional investment help and the high-stakes world of this particular stock. In summary, the narrative of GameStop as a simple retail phenomenon is now a relic. The expectation of a stock driven solely by social media sentiment fails to account for the complex financial engineering of its warrant issuance and the increasingly sophisticated institutional money playing in the shadows. The belief that recent profitability from cost-cutting is a sign of a healthy business overlooks the stark reality of declining revenues in its core operations. The future of the GameStop stock is not a simple question of whether the apes will win. It is a question of whether a legacy retailer, armed with a mountain of cash and a cult-like following, can execute one of the most difficult business pivots in modern history, against a backdrop of ferocious competition and technological disruption. The tension between the powerful, enduring expectation of a stock that defies gravity and the cold, hard reality of its monumental operational challenges is what will define its next chapter. Understanding this duality is the key to truly understanding the state of play for GameStop.